You just have come off of a quarter in which you brought more money in 3 months than you often do in a single year. How does this continue into the new year with all the troubles we're seeing in the economy?
Well, Shanali, it's great to be here. I just want to take a moment and talk about this quarter and the year we had, which were amazing and the best in our firm's history. We had $155 billion of inflows, as you noted, in terms of record levels, AUM up 42%. And it just reflects the fact that we continue to deliver for our clients. We had our best performance in our history, and we continue to broaden our platform, investing with retail investors, insurance, and so forth. And that's giving us powerful momentum and record results.
So, John,
now, how does this, continue? That was your question.
Yeah, with record results have also come record pay. I mean, the amount that you have risen your compensation and benefits has outpaced most of Wall Street. There's a war on talent going on out there, and I want to know how that positions you moving forward.
Yeah, so two things I'd say. As it relates to talent, one of the great things about our business is we have this long-term alignment where our investment professionals benefit from rising incentive fees and performance fees. So when we deliver for our customers, their compensation goes up. Obviously, on a year like 2021, that bodes well for our individuals, and it creates variability in our comp structure if things head in the other direction. So we've got, I think, a special position, and we've been able to pay our people well and still grow our margins. So we feel really good about that. You also asked about fundraising continuing, and on that point, what I'd say is, even with the markets off, the S&P is still up 40% from where it was 2 years ago. And we're also seeing the fact that I think a lot of investors are going to be looking to move out of fixed income. And we think alternatives in our firm will be a beneficiary. So on multiple fronts, we feel pretty good.
Now, a lot of people are worried about the market today, but you're investing in firms for 10, 15 years down the road. So are you taking advantage of this opportunity to deploy more money in any case?
Well, we certainly, as investors with new capital, we have $135 billion of dry powder, recognize that prices, particularly in public markets and in sectors like technology, can create new opportunities for us. So yes, our teams are on the ground. We're looking for markets that have gotten potentially dislocated. At times like this, investors can sort of throw the baby out with the bathwater, and that creates opportunities. So, yeah, we're looking at things, and it's helpful for new capital.
On the entirety of small business, you have a real bird's eye view on small business America and some of these medium-sized firms through your investments. How significant is the inflationary pressure at a time where we've been talking significantly about how big companies are able to withstand it a lot better?
Look, I think inflationary pressure is hitting everybody. It's hitting small businesses, it's hitting consumers, and it's hitting big businesses as well. I would say, stepping back, what's happening to the economy is really a series of shocks, both demand and supply shock. On the demand side, the $10 trillion of stimulus, fiscal and monetary, has led everybody to have more consumption power. So you see people buying appliances and cars, traveling. That's creating a huge demand pull shock. And on the supply side, we've got shortages in energy and commodities, labor, housing, all those areas, and that's driving prices up. And so this definitely feels like it will be persistent. It's certainly pervasive, and companies have to alter to that. The companies that are most vulnerable are those who have a lot of input costs. So if you think about a business that has a lot of labor cost or a business that has a lot of raw materials, and they don't have the ability to pass on price, maybe like a food manufacturer, those are businesses that are vulnerable. There are other businesses, of course, that have more pricing power and less exposure to those input costs. Fortunately, a lot of our portfolios oriented that way because we've been worried about inflation and ultimately the normalization of rates as well.
Jonathan, there is a concern here about a repricing in public markets, how far it has to go. And yet, we have heard that we really have not seen that repricing in private markets. People aren't selling, so you're not seeing that real-time adjustment to this higher inflationary outlook and, frankly, a Fed with a very different tone. Do you expect the private markets to materially correct in the next 6 to 12 months?
I think the private markets and public markets clearly correlate. And I would say sometimes there is a lag, to your point, but oftentimes what you'll see is a slowdown in private market activity. So you could see less companies being sold as people reprice assets a little bit. That can be the case. I think where it's probably most pronounced is in the technology and growth areas where the public markets have pulled back. And so I think on some of the rounds of some of the private companies, fast-growing companies, there'll be a reset. That takes a little bit of time. But I would point out not all markets have pulled back. The real estate market, for instance, because the fundamentals are very strong, particularly the sectors we're focused on, we're seeing pretty robust sales. And I think some sellers are thinking about selling. They're worried about rates. So I'm not sure all markets have pulled back in the same way. But to your point, there is a lag at times in the private market.
John, you mentioned a worry about rates twice in the last couple of minutes. I'm wondering what you think about what John Waldron over at Goldman Sachs had to say about what's gone on in the last couple of years, bringing into question the independence of the Fed and its ability to really control the trajectory going forward.
Well, there are lots of Fed pundits. I'm happy I've got my job. I'm not the Fed chair. What I would say is I'll focus on the future because that's what really matters as investors. And I think the future is pretty clear that the Fed realizes inflation has become elevated and they've got to modulate what they've been doing. And so they're going to shrink the size of their balance sheet. They're going to raise rates. And that's the new environment we're in. And as investors, I think you want to be thinking about that. You want to be thinking about an environment, at least in the near to intermediate term, where growth is actually pretty good, but inflation is running higher and the Fed is raising rates. And you want to buy assets that can do better in that kind of environment.